Walter, I just want to know how you value a company like Amazon anyway, when there's so much investment being made by that company. It's hard just to judge them by the bottom line when the company's spending so much on the future.
It's difficult to do, and that's one of the reasons we avoid a name like this. Is it is difficult to put a value on it because there is such lumpiness in the quarter. This quarter is a perfect example of that, and it's very tough to get your arms around it. I mean, when you look at the total valuation of the company, almost $500 billion, it just seems a little elevated at this point given the margins that they're operating under. The other point I would make real quickly on Amazon is that everyone's giving them a free pass on this Whole Foods acquisition. This is the largest acquisition they've done in the history of the company. They've increased their workforce by 25% with this acquisition. I think there's some execution risk with that deal.
Rob Morgan?
I tell you, I really like the tech space. I think it's attractively priced. You've got visible earnings coming down the road. You've got nice technicals. But I tend to agree with Walter that, well, certainly Amazon is a little rich. I would actually go a little farther and say that the whole FANG space is a little rich. But I do like the sector in general.
So you like the sector from a strategic point of view, but you don't like the price of the story?
The price of that sleeve. You know, Walter mentioned Microsoft. There are certainly other dividend growers, and Apple. And I don't own any. As far as disclosures go, I don't own those myself. To have an investment banking relationship, but yes, do like the space. Not so crazy about the priciness of FANG.
So, Walter, what did you make of what happened yesterday, though, in the market? We're sort of on no big news. We wound up having a dip, really took it hard in terms of tech stocks as well. And then you have Amazon that continues to roll it over. We here in the press said it was because of this JP Morgan note that basically warned of volatility. The tide could be turning. The shakeout and the risk parity funds could be as high as $500 billion are invested in those funds. Do you buy that kind of explanation?
Well, I think what you're seeing with the market here is that when we're at all-time highs, volatility is at historic lows. The market's very skittish, very quick to hit the sell button, and I think you saw that yesterday. I think we've seen that actually for the past couple of months, starting on that June 9th Friday, where we got the first sell down in technology. And so I think investors make the mistake that it feels good to buy when volatility is low and stocks are at all-time highs, but it's actually a more risky proposition to buy in that time frame. And so I think what you saw yesterday was just indicative of kind of what we've seen, the churning, even though the market overall has been rising. You've seen this churning underneath, going back and forth between growth and value, between tech and financials, for example. I think that's what you're seeing, and I think we're going to, as we enter a more risky period historically in the calendar, I think you're probably going to see some more volatility and some more days like we saw yesterday.